Welcome to Street Check, the weekly podcast from Cabot Wealth Network, which has been publishing investing research, insights, and recommendations since 1970. I'm Chris Preston, Vice President of Content here and Chief Analyst of our Cabot Stock of the Week advisory.
I'm Brad Simmerman, Web Editor and Chief Analyst of the Cabot Wealth Daily. Today, we're going to talk about recent market performance, whether it's just the bull market settling or if the Fed's is back on the market's back. We're going to talk about standardization of the EV supercharger network and new companies coming on board with Tesla. And then we're going to talk a little bit about international investing before we move on to our main theme this week, which is the VIX and volatility in the market and how to play it. Chris, do you remember in the last couple of weeks, Rich wrote about an AI stock that he was talking about hype cycle investing that had traded more shares in one day than were outstanding. So it was this micro cap stock, and it only has like 3 million shares, and it traded 7 million in a day. Do you remember that?
I don't know. Maybe you saw that. I might have missed that one.
Okay.
Do you remember the net? Well, I guess we can't say the name of the stock, but
yeah. Well, I don't remember. It was a hype one. It wasn't like a legit investment, but I just watching Chris Paul get traded twice in like 3 days just reminded me of all that trading hands. You watched the draft last night?
I did watch the draft last night. Yeah, I don't know. I don't have any real reactions. Yeah, Chris Paul getting traded. It's funny. I know two people who are involved in Chris Paul trades in the last week. You are a Suns fan, and my brother-in-law is a Wizards fan. He's the one. Yeah, you both had the Chris Paul experience, and now you don't anymore. So.
Yeah, I guess his was a little bit more painless. Our Chris Paul experience was supremely painful for 3 years.
Yeah, he probably barely even noticed because he literally didn't play. Okay, so first, before we get to the big three and the VIX, we have our defend the take, and you're up this week, Brad. Your take this week, for which you have 90 seconds, is that ESG investing is meaningless. Go.
Yeah, so when I originally pitched the take, I think I said ESG investing is dead, but we say everything is dead because it's hyperbolic and gets eyeballs or clicks or an emotional response or something. Theoretically, yeah. No, so ESG investing, the Journal of Finance did an analysis of 20,000 mutual funds representing 8 trillion in assets under management. And they found that there was no material difference in performance between buying ESG stocks or buying ESG funds and buying non-ESG funds. And they attributed it to a couple of things. One being, if a company is actually pursuing ESG goals, it can be tougher to turn a profit. So if you're buying companies that aren't cutting corners when it comes to labor force and equity and things like that, then they can outperform a little bit. But the other attribution is that it's greenwashing, right? We talked a number of times about how companies' earnings releases are all screaming AI or they're all screaming metaverse. Companies have been doing the same thing with ESG. And one that I wanted to note was Engine Number One. In May of 2021, they got a ton of headlines. They're a fun company because they were able to place 3 members on Exxon's board, and they're an ESG-focused fund. They got 3 members on Exxon's board. After 2 years, the net result is that Exxon is slowing CapEx and focusing more on clean energy and environmental causes. But that's the same thing that every other major oil company is doing. They're cutting CapEx expenditure and they're returning cash to shareholders. So. My big takeaway is vote your conscience. You're not going to take a performance hit if it's important to you to invest in ESG stocks or that your investments align with your moral values, but it's also not going to be a guaranteed profit or it's not going to supercharge your portfolio. So you can confidently vote your conscience, but it's not going to really improve performance that much.
Right. Yeah. I mean, I'm sure people have certain companies they stay away from. Maybe people are reluctant to invest in the big oil companies, period.
Tobacco, firearms, stuff like that.
Tobacco, firearms. Yeah. Maybe some people avoid cannabis companies or whatever. Right? Maybe there's some people who don't want to invest in green tech. I don't know. But yeah, I mean, I feel like it feels like you don't hear as much about ESG investing as you once did. It feels like it was not a fad, but it was, something that was all the rage in a big fancy term. And now like the playing field is level.
Yeah,
Yeah.
there's been some political posturing around it lately, which sort of resurfaces it in the headlines, but that's really all it is posturing.
Yeah.
Investors are not better or worse off by ESG being a concept.
Right. Okay, let's move on to our big three. And we'll open with, as you mentioned. So the Fed did not, it's interesting. Last week when we were here, the Fed had just, they paused the rate hikes for the first time in 15 months. But they also indicated that there was a chance there'd be 2 more rate hikes before the end of the year. You and I both fell into the camp of there'd be less than 2. I think you said you thought you might be 1. I said I'm holding with 0, but I'm feeling less confident about that by the day. But the market was down this week as the Fed sort of just reiterated that. Seems like they are kind of doubling down on we're not done. This pause is temporary. We're not done raising rates. And stocks were down this week. Is this the Fed actually being back in the picture as a market worry? Or was this week just normal market consolidation after a big run up?
I'm more in the latter camp than the former. Fed testified. It was the monetary policy Senate testimony, right? He came out and said, people that are hoping for rate cut, he doubled down on the fact that people that are hoping for rate cuts are going to be disappointed, right? That is not in the cards.
Yeah, and neither of us ever said we thought that was.
Yeah, but he doubled down on what he's been saying, which is, hey, we're going to look at the data. Rates are going to be higher for longer. I do think that it's more consolidation after a big run up. The one thing that does make me maybe a little bit more concerned, or at least raises a yellow flag for me, is that we've seen broad selling. If it were a picture perfect consolidation, we would see selling sort of limited to the leaders. So, right, we would expect to see the NASDAQ come down and the S&P come down and the Dow sort of stay flat because because of the narrowness of the rally. Right, like the mega cap tech stocks giveth and the mega cap tech stocks taketh away. Yeah. So if they're the only ones consolidating because they've been driving the rally, I would expect to see mixed performance in the major indices, but it does seem like that selling pressure is a little broader than what I would like to see ideally.
Yeah, I mean, like I said, I'm not really concerned. This is normal, normal deep breath after a big, the market flipped from bear to bull 2 weeks ago. Then last week it went from being a sort of technically a bull market to feeling like, where initially it felt like just the mega caps and a few AI stocks were participating, to being much more feeling like a real bull market, or at least more real than the previous week, last week. So, after a big run up like that, pullbacks are normal and healthy. I think we're down less than 2% this week. If it goes down anywhere from 3 to 5%, I wouldn't be surprised, and nor would I be concerned. Anything beyond that, sure. But I don't think this is the Fed. If a week ago the people were concerned about the Fed raising rates potentially twice, why would they suddenly be concerned about raising them twice a few days later? It's all about there
perception.
More sellers than buyers. A lot of people wanted to probably sell high this week.
Yeah. It, like you said, nothing has really changed. Big picture with the Fed, nothing has changed. There's no reason for that to be more evident on the radar. It does feel, for the time being, like a healthy consolidation. I think, most of the analysts that we read that Cabot has are in the bull camp right now. But we're also doing what the Fed is doing, and we're just going to look at the evidence. So
move on to number 2.
Yeah, let's move on to number 2. Tesla got a little bit of a boost earlier this week when they announced that they were opening the supercharger network up to Ford, GM, and Rivian as well. I believe they were quoted, I believe I saw quoted $3 billion a year in additional revenue for opening that supercharger network. And GM and Ford both announced plans to add the Tesla charge port to their EVs starting next year. Good, bad for what parties? It feels like it's good for Tesla, right? It builds their network out further.
Yeah.
I would say it's probably good for Ford, GM, Rivian because it's standardizing the charging network. One hypothetical that we had talked about is like, all right, imagine if your car had a different gas tank or gas, like you had to use a specific nozzle to get gas. You couldn't have a broad-based auto network, right? It would be an unimaginable nightmare. And this standardization of the charge network feels like a very important part of a broader EV build out, even if there's going to be some winners and some losers.
Yeah, I mean, I think, like you said, Tesla's definitely a winner. I mean, this just the Ford and GM deals alone supposedly will actually add $6 billion in revenue over the next few years for Tesla, and I'm sure more beyond that. And that doesn't include the Rivian deal. Like you said, Ford and GM, they get access, and that's good as they build out their EV portfolios. Rivian, definitely good. But then there's a company like ChargePoint, which is one of the top makers of or manufacturers of electric vehicle chargers. Their stock is down 18% since that news came out. Yeah, I think in the long run it will be. It's what type of thing that rising tide lifts all boats in the industry. But for now, in terms of the short term, it feels like it's a ding on companies like ChargePoint or other EV charging companies or EV makers that aren't involved in this deal. But as you build out the network more, it'll benefit all, I think, and that includes even companies. Who knows that ChargePoint won't ink a deal with Tesla to expand their network as Tesla wants to ink more of these deals.
Yeah, I mean, like, nothing stops ChargePoint from saying, "Hey, Tesla, here's $250 million a year. Let us license your patented technologies for our chargers, and then we'll have Tesla adapters too, or we'll have Tesla plugs too." But we'll just have to see how it plays out. There's going to be winners and losers from this, and there's no guarantee that a company like ChargePoint stays in business and thrives and is able to sort of ride Tesla's coattails or ride the EV wave. But it's also not an immediate death sentence. So, I think people should probably be taking sort of a wait and see position there.
Yeah.
But let's move on to our third story, or our third of the big three. We want to talk a little bit about international investing. India's Modi is currently being hosted by the White House, and
is he still there?
I don't know.
Yeah, long visit. It's a long trip, so I guess it makes sense for a long visit. Yeah.
Yeah, and I mean there are things. Statecraft is so hard. We were talking about ESG and sort of following your moral compass, and then you look at a country like India, where there are legitimate humanitarian issues in that country, but it's also now the biggest country in the world, and we want to foster a good relationship internationally with them. So it's like, all right, well, what do you overlook? So from a statecraft standpoint, what do you overlook in order to achieve your goals? From an investing standpoint, you ask the exact same question. What are you willing to overlook to achieve your goal? So keeping that sort of in the back of our mind, let's run through the international countries that you're sort of most inclined to invest in that are
are not US or China, the two obvious ones, right? Yeah.
Right.
Yeah, I mean, moral compass aside, yeah, India, while growing, I mean, as you mentioned offline, the poverty rates there are still very concerning. I think part of what you're looking for, and this is something Carl Delfeld, who runs our Cabot Explorer Advisory, mentioned when he invested in a company that does business, does business manufacturing in Mexico. You're looking for countries that have huge discounts to U.S. and Chinese manufacturing, and Mexico is one of them. 25% discount generally. I know India is too, but Mexico maybe doesn't have some of the same hangups as India, and proximity to the U.S. certainly helps.
The nearshoring effect is going to pay dividends, because so many people are still seeing fallout from the supply chain issues we had during the pandemic. It's still a priority for countries, or for companies to be able to do more business locally. And if India is your manufacturer, you've got global shipping to contend with, whereas if Mexico's your manufacturer, you can run it on a semi, right? I'm 4 hours from Mexico by car. So it's a lot easier to get the input to the supply chain with that proximity.
Sorry,
go ahead.
I was say, and that's all that's right. Another one that I think is more of a very deep value play, or it has been until recently, Japan. Japan has 5 of the top 100 companies by market value in the world, behind only the U.S., China, and I believe Germany has 6. And yet its stock market, the Nikkei 225. I couldn't believe this. I knew it was something like this, but it's incredible to look at. I mean, it's trading at 32,000 now. It was at 38,000 in 1989. That was the top. I know that's, famously Japan's stock market has gone nowhere for like 3 decades, more than that. But it's still shocking to look at. But year to date, it's up 25% in the last 2 years. Last 5 years, it is 45%. Not gangbusters, but it might finally be meaningful growth. I mean, it bottomed at 2009. This index was down to 7,000, and now we're at 32,000. So that's something. And then its GDP growth is improving. Expected 4% in the third quarter of this year over year, and 3.5% the quarters after that, up from 1% this quarter. So Japan, I think, is sort of a long held value play that I like. It seems like it's gotten off its knees a bit.
There's still demographic overhangs with Japan that are very similar to most of the developed Western nations, right? Like the Eurozone and the US, where you've got this sort of gray ceiling of aging individuals, where your youth population is so much relatively smaller, that there's legitimate questions about sort of how do you support the growing aging population. So that'll be something for all of the developed world to contend with. One alternative that I know Carl likes, that he's written about before, is some of the Southeast Asian countries like Vietnam. Relatively easy to invest in. It's one of the few Southeast Asian ETFs you can just go buy, like VNM, I believe is the ticker for the Vietnam ETF. So it's pretty easy to get exposure. Young population, economic growth, not subject to those same demographic overhangs as a lot of the developed countries. Technological infrastructure in Vietnam is strong. So I like them as an alternative Asian play that's maybe more growth oriented than value oriented.
Yeah. And so for people who are concerned that the US, how quickly things have changed. Bear market again, 2+ weeks ago, and now we're talking about how everyone's worried that the US market is overcooked. If you're one of those people, then Vietnam, Japan are certainly undervalued places to go. Mexico too, it's because of its manufacturing discounts. Okay, let's move on to our theme for today, and that includes a guest who we welcome back, who was here just a few weeks ago. That is Andy Crowder, who is chief analyst of our Cabot Options Institute newsletters. Andy, today we're going to talk about the VIX volatility. Volatility is the lowest it's been, according to the VIX, in more than 3 years, January 2020. I know part of the reason that you have outperformed, so let me just go over some of the numbers. I know we mentioned them a few weeks ago when you were on here, but they've improved even since then. In your quant trader service, you've have 31 out of 35 winning trades in the year plus, a little over a year since it launched, 160% return. I mean, that's a pretty strong performance given what the market's been. And a lot of that you used high volatility to your advantage. Does the low volatility now, does it make it harder, or how do you shift?
First of all, good to be here. I thought you were going to start out with some Chris. I thought you were going to start out with some Chris Paul questions. You know, we could talk Wake Forest.
We did that. I think there's enough. 45 seconds of Chris Paul on an investing podcast is probably 30 too many.
Yeah, that's probably true. Yeah. So regarding the VIX, yes, we benefited certainly from having that high volatility really throughout all of our services, because the majority of what I do is I sell options. So of course I want to sell things at a higher price, and when volatility is higher, because it's a major component of the options pricing model, that we again prefer to sell things higher, so we're able to bring in more money. So we definitely have benefited from that. But as we've seen the VIX push lower and lower and lower, we still had success, because ultimately what happens is a 80% probability is an 80% probability. Probabilities aren't going to lie. They're not going to shift. So the market adjusts to that lower VIX. Now, so again, we've had a lot of success. Now, where option sellers kind of get caught, where they get caught is when we have those transitions and when they happen rapidly, where you have huge spikes in vol, or you have, the exact opposite, where we see a sharp decline in volatility. And those transitions from high volatility to low volatility environments and vice versa, again, those are kind of the difficulties and the challenges for option sellers. But again, if you're hedging your positions and you're using a variety of different strategies to take advantage of different, market environments, then you should be good. And that's exactly what we try to do within all of our services, and they kind of all blend together to work in unison.
Yeah, what you're saying about the transition phase being the damaging period reminds me a lot of duration mismatch that killed the banks, right? Where it's like, okay, well, we're locking in this low yield for this amount of time. It very much feels like a duration mismatch problem that you could sort of hedge against by varying the length of your contracts. I don't know if that's accurate or not, but that was the first impression that I took.
Well, it is to some degree. I mean, the way to kind of combat those transitions is just to use different strategies, and just continue to use those different strategies. So those transitions in volatility doesn't necessarily impact your overall portfolio, but certainly if you have a low implied volatility environment, you have to, oftentimes it's a fight between, do I want to bring in or try to bring in the same amount of premium, or do I want to stick with probabilities? And you can't have both, so you kind of have to choose. So if you're choosing the premium side, then you're wanting to go out further in duration. And really the same goes for probability, but so it's just a matter of that margin of error. What do you prefer, margin of error and a wider margin of error, or do you prefer more premium? In my case, I always prefer the probabilities, but certainly when you have these low implied volatility environments, going out further in time, going out further in duration will be more advantageous for bringing in more premium. It doesn't necessarily mean that you're going to be successful, because you're exposing yourself to a little more time. But certainly it allows you to bring in more premium if that's what you choose.
So one thing that Jacob wrote about to his Cabot options trader subscribers pretty recently was the lower VIX also makes it cheaper to insure your portfolio, right? Like you can go and buy some longer dated puts. It's also cheaper to take speculative positions. I would interpret from that. How does the lower volatility impact one of the strategies you use, the poor man's covered call?
So to kind of go back to what Jacob was saying. I'll talk about that first, and then Brad, you're
Yep.
going to have to remind me what your question was, because ultimately I will forget. So, the great thing about, and Jacob is definitely correct. The problem is that no one wants to insure their portfolios when the market's moving higher and higher and higher, and you see the VIX lower, and they should be. This is the perfect time. You can go out, you can buy, I mean, you can insure your portfolio in many different ways, but now is the time that you want to start using those portfolio insurance type techniques. Whether you're going out a year, 2 years, or 6 months, but vol's very cheap. So it's cheap to buy options right now. Now, not in everything, but generally speaking. Going back to how this impacts poor man's covered calls, doesn't impact us whatsoever. Yes,
You want
we
to just quickly
cannot sell
explain what a poor
premium.
man's covered call is?
So a lot of people use covered calls, and that's what they're accustomed to.
Yep.
And a covered call is you buy 100 shares of stock, and then that allows you the ability to sell one call contract against your 100 shares. And the reason why it's 100 shares is because one options contract is equivalent to 100 shares of stock. A poor man's cover call is, rather than buying those 100 shares, you're buying what's known as a LEAPS contract. And a LEAPS contract is a long-term equity anticipation security. It's a horrible acronym, the way that they choose that, but nonetheless, that's what it is. So anything with a year or more left in its life, that being an option, is considered a LEAPS contract. So again, rather than buying those 100 shares, you buy a LEAPS contract, and it allows you to buy something for 65 to 85% cheaper than buying those 100 shares. And then after you purchase a LEAPS contract, then you basically follow the same type of format that you would with a cover call. You're just selling calls every 30 to 60 days. At least that's how I do it. And you continue to that in perpetuity. So the great thing about when you're using a poor man's cover call is that, particularly if you're using an actively managed portfolio, and we have growth portfolios, which we've been very cautious in those, but we're starting to add positions to those portfolios. It allows us to buy LEAPS at a very cheap price right now, which is awesome. So, and we're going to hold those for at least a year, many of those positions, some of them maybe not, but for the most part, we will be holding those. The problem is that, again, selling premium is going to be a little cheaper, but ultimately these are long only portfolios, that being the way that we approach poor man's cover calls. So we benefit from the upside. So it's great for us as the market continues to move higher.
Part of what prompted me to bring that up was just the thinking that you can leg into the LEAP side of things cheaper now, with VIX being really depressed. In the event that volatility starts spiking, when your 30 to 60 day covered call component of the LEAP is expiring, you're going to see your premium grow as volatility rises. So if there is a sort of duration volatility mismatch, you can leg into the long side inexpensively now, and then you will be taking advantage of increased volatility in the event that we experience it.
Yes, that's true for the short side, and remember, the LEAPs are also going to increase in price as that volatility increases as well. Not as much as those short dated options, but they will increase as well.
Yeah, go ahead, Chris. Sorry.
I was gonna say, and is your expectation, the last time that volatility went from this high, or as high as it was, even as recently as the beginning of this year, a few months ago, to as low as it is now, what typically happens? I mean, is your expectation that this will flip and volatility will spike in short order, or does it usually stay down a while once it dips like this?
It's, as we say here at Cabot, no one has a crystal ball. So I'll say that again. All I can say is that in 2008, we had, that's when I think volatility spiked above to where it was during the pandemic. And then, that was the latter part, but that was also right before that, that was one of the best years for the market, was what, 2007, 2008, that period. And then it started
07, like September 07 is when it flipped, I think.
So that was the best performing year. Or no, we went in, I'm sorry, last year was, let me start fresh. last year was an awful year for the market, particularly the Qs. We saw that same thing happen in 2008. Well, in 2009, that's the best year that we've seen over the last 20 years. Right now, particularly in tech and the Qs, this is the best start that we've seen the Qs have in the last 20 years ever, or over the last 20 years. I mean, it's way above.
Yeah.
What happened the following year is it, back in 2008, 2009, it's exactly what's happening right now. We're seeing vol crush. So oftentimes, people use the VIX as a mean reversion indicator, and it's a pretty decent short-term mean reversion indicator, particularly when it gets oversold and overbought. But we've seen periods where the VIX has bounced around between 10 and 13 for a year, 2 years, so it certainly can happen. And it's difficult if you're out there selling, because it's ultimately almost like a bear market in volatility. So you have to be much more selective. You can't just go out and sell SPY over and over and over and expect to bring in those same returns. So if you're expecting if your normal returns are 15 to 25% during a normal volatility market, you have to expect, if you're doing those same trades, to bring in a little less premium. Again, it doesn't mean that your probabilities are going to change. And ultimately, that's what we make our decisions on, are those probabilities. Because again, an 80% probability is an 80% probability in any market. It doesn't matter. And that's what the market tells us in real time. But so we're really not doing anything different, and there's no real challenges at the moment, but certainly the VIX could stay here for quite some time.
Yeah, just to put some numbers on it, you mentioned 10, 13 ranges. Now at 13, this is the VIX is the CBOE volatility index. It was as high as 25 in March, and into the 30s end of last year, October, when the market hit its lows, it was 32. So we're less than half that now. So that's how much the volatility has declined in the last just 6 months, basically.
Yeah, I think a lot of people have been surprised by how much it's declined over such a short period of time.
Yeah.
Can I pitch a potential explanation and let you shoot it full of holes?
We can try.
Okay. So we've seen dumb money sentiment indicators showing that retail investors are highly bullish and a lot of institutions are still on the sidelines. Would a lack of institutional participation, and thus a lack of institutional speculating and hedging, be a significant contributor to reduced VIX? In other words, are we simultaneously seeing a bull market rally being driven by retail while seeing no institutional participation, which is reflected in the VIX? Is that a reasonable assessment?
That is definitely a reasonable assessment, and I think I'm not going to say that's the reason why, but that's certainly one of the reasons why we're seeing this. Because again, I mean, we're just seeing in Bloomberg, Wall Street Journal, we have the short bets right now are through the roof. We're at record levels, but we've been there for quite some time, not necessarily at these levels, but it's been building as this market has continued to advance. Most of those people that have been jumping on board as of late have been retail investors, not institutional investors. They've been in the game, that being shorting the market, for quite some time, right? So them being on the sidelines and not actually going out there and hedging their portfolio, because essentially they're already hedged, and they so that's
cash, right?
Yeah. So what happens is that there's no one really getting in there and hedging, and we're not seeing that demand so much. So that certainly impacts the VIX. But there's a lot of things that have impacted impacted the VIX moving to the levels to where it is today. But again, I'm surprised that it's pushed this low. I thought it was going to kind of kick back when it hit 15, but I knew once it pierced 15 that the bottom was kind of falling out, and we could go down to single digits. No one necessarily knows, but it also wouldn't surprise me to see this market push higher. We've had gaps in the market. The Qs, the NVIDIA push after the announcement caused the gap in the Qs, and then we had gaps in the Russell, the small caps, in SPY and in the diamonds, and that was on June 2nd, I think. None of those have been closed. So so to see this, and that was the thing that we've seen in these raging markets also. is that it's okay to see 5-10% pullbacks. Those are normal. But I think a lot of people are accustomed to 2021 when the market was just going higher and you were buying every dip and everything was good. Well, that's also when a lot of people came into the market, right? With all the COVID, with all COVID money, people just pushing money into the market. So I think that mentality is still there. It's, you know, short-sighted, but to see a 5 to 10% pullback is very normal for the market.
Yeah, I think we're seeing those same risk on conditions in crypto, right? Bitcoin up 10% in the last week or 15% in the last week. It very much does sound like a 2021 redux, at least from from a retail investor perception standpoint.
Yeah, I agree. It's been a very powerful market. And here's the other thing: it's like a lot of people were saying, "Oh, we have 5 to 7 stocks leading the charge," and that has been the case, except as of late. If you look at an equally so the Nasdaq's up what, close to 40% this year, just in six-ish months.
Yeah.
And for the longest time, there was a huge divergence between those tech leaders and then the rest of the companies within the NASDAQ 100. Well, now if you looked at an equally weighted chart for the NASDAQ 100, it's up 20%. If you took that by itself, you would say to yourself, wow, this is the NASDAQ's having a great year this year. And that's just equally weighted up 20%. So it's a very interesting market right now because there's a huge tug of war going. A lot of people, you know, on the bear side, a lot of people on the bull side. A lot of things that I look at are leaning more towards short-term bearish. That doesn't obviously, you know, I think we're seeing a little bit of that now. How long that lasts, though, is anyone's guess, and it would not surprise me to see this market push back higher. I would like to see those gaps close that I mentioned before and then kind of resume, and that's typically what we see. But we'll see what happens.
Andy, before we let you go, I know you have a webinar you're doing, I believe, is it next Thursday? Is it next Thursday?
Yes, next
2
Thursday at 2 o'clock, I think.
What's the name of it? Where's the theme?
So we're going to talk about Quant Trader. We're going to go through the strategies step by step, and then we're actually going to have several live trades at the end where I will move over to my platform and then just kind of walk through some trades so that people can see exactly, you know, what I'm doing, how I, you know, my process, how I choose the particular strikes that I choose, how I choose the particular ETFs or stocks that I choose, etc.
Yeah, it sounds like I said at the top, 31 out of 35 winning trades in the year since you launched Quant Trader, and 160% return. Pretty good, and that hasn't slowed since the VIX has plummeted. So that seems like a pretty good sign that it's pretty all weather strategy.
Yeah, no, it's well, that's the thing. It's like I said before, we use for each expiration cycle. I'm using a bullish strategy, bearish, and a neutral based strategy for the most part. I've been using more bearish and neutral, you know, over the last 6-7 months, but ideally that's kind of what I want to use. So they're constantly hedging each other, which gives us that benefit. And yeah, it's, you know, like I said before, we've seen these types of low implied volatility environments many times, and option sellers don't stop selling options. We have to adjust a little bit, but that's normal. So,
and for anyone who wants to sign up for your Cabot Options Institute, you can go to the cabotwealth.com website under premium advisories. It's all there, or under premium memberships is Cabot Options Institute Masters Club, which gives you access to all 4 of your advisories, all of which have done well and beaten the market since launch a year ago. Andy, thanks for joining us today. And you sure you don't want to talk about qubits or quantum physics before we get off, or did we cover that?
I wanted to talk more about Chris Paul and Wake Forest and
Wake Forest. Yeah.
So I'm gonna make one final appeal to listeners. If you've been following Andy's stuff at all, attended his webinar, reading any of his content, and you've seen him discuss poor man covered calls, and you've maybe been on the fence about it, one other advantage of a low volatility environment is that it's less expensive to try a new strategy. You can leg into a poor man's covered call as inexpensively now as you could have at any point in the last 2 years. So if you're interested in trying a new strategy, or if you're interested in beginning to trade options, they're cheaper as a buyer, but they're also less expensive. They're less profitable as a seller. So now is a way to maybe try some of those strategies in a lower risk style or lower risk flavor.
That's why Brad's
Yeah,
our
you're
Chris
exactly
Paul,
right,
dishing
Brad.
out
Thanks.
assists to Andy all over the place, despite his.
That's right. Thanks,
age.
Brad. I appreciate it.
I'm also the biggest counter indicator. So, well, I guess that's I'm Chris Paul, right? Like a dish assist, but no championship, right? That's what.
You said it. I didn't. Well, Andy, thanks again for joining us, and thanks to everyone for listening to the latest edition of Street Check. Again, as always, if you haven't already done so, subscribe, hit that like button, give us a 5-star rating. All helps us. We will be back next Friday, and we'll talk to you then.